Before the digital age, financial reliability was judged by a handshake, a local banker's intuition, and highly subjective character assessments. This localized system was inherently flawed, often locking capable individuals out of the broader economy based on personal bias rather than objective mathematics. The mid 20th century brought a sweeping demand for fairness in lending, sparking the creation of a standardized numerical representation of risk. This evolution stripped away personal judgments, replacing them with cold, hard data points that could be universally applied across the entire financial sector. That demand for mathematical objectivity eventually gave rise to the FICO score, fundamentally altering how lenders evaluate trust and distribute capital. Instead of relying on a human being's mood on a Tuesday morning, financial institutions began consulting standardized models to predict borrower behavior with ruthless efficiency. This score became a universal language, a digital reputation score determining who gets a mortgage, an apartment, or even a job. Yet, decades after its introduction, the exact mechanics driving these three-digit numbers remain shrouded in mystery for the average consumer. Demystifying the math behind this system requires looking closely at the raw materials used to build it. Three major credit reporting agencies continuously vacuum up data from banks, lenders, and creditors across the globe, compiling massive dossiers on consumer financial behavior. These agencies do not calculate the final algorithmic score themselves, but they provide the essential ingredients required for the formula: every missed payment, every newly opened account, and every revolving balance is meticulously recorded and fed directly into the scoring engine. A common and deeply felt frustration arises when a consumer pays every single bill on time, yet watches their score mysteriously plummet without warning. Many operate under the logical assumption that punctuality is the only metric that actually matters, treating their credit card like a simple pass through mechanism for their daily living expenses. They diligently pay the full balance on the due date, assuming their financial virtue is perfectly reflected in the system. The sudden drop in points feels like a betrayal by an opaque and unforgiving machine. The reality is that the algorithm weighs five distinct factors to generate a final score, and punctuality is only one piece of a much larger puzzle. While payment history forms the absolute bedrock of the calculation, accounting for roughly a third of the total weight, it is closely trailed by a highly volatile, entirely separate metric. This secondary factor measures exactly how heavily you lean on the credit you have already been granted. It is the hidden lever that can rapidly swing your rating by dozens of points overnight. That powerful lever is the credit utilization ratio. It represents the specific percentage of your total available revolving credit that you are currently using at any given moment. If payment history proves your historical willingness to repay a debt, this utilization metric signals your current financial capacity and your immediate reliance on borrowed money. Lenders view a nearly maxed out card as a blaring distress signal, a mathematical indicator that a borrower might be severely overextended and potentially one minor emergency away from a catastrophic default. The calculation itself is remarkably straightforward, requiring only basic division to uncover the truth. You simply divide your total current credit card balances by your total credit card limits, then multiply by 100 to get a clear percentage. If you hold a single credit card with a $10,000 limit and you currently owe $3,000, your ratio is exactly 30%. Every single time that balance fluctuates up or down, the ratio dynamically shifts, instantly altering your perceived risk profile in the marketplace. Consider a household managing daily expenses by funneling all groceries, gas, and utility bills through a single rewards credit card to accumulate points. They might easily rack up $4,000 in everyday charges over a month, fully intending to pay it completely off from their checking account. Even with a combined credit limit of $8,000 across all accounts, this routine behavior pushes their utilization to 50%. To the algorithm, this looks incredibly risky, completely regardless of the ample cash sitting safely in their bank. The realization that temporary routine spending can trigger a massive score penalty often brings a sudden wave of financial anxiety. It shatters the comfortable illusion that simply having enough money to pay the bill is sufficient to maintain a pristine digital reputation. The automated system does not care about your good intentions or your actual bank balance. It only cares about the rigid snapshot taken on a specific day of the month. This blind spot leaves countless responsible spenders feeling unjustly punished for simply playing by the rules. A pervasive cultural myth suggests that keeping this ratio under 30% is the ultimate goal, serving as a safe harbor for your credit score. While staying below that arbitrary threshold is certainly better than maxing out an account, the mathematical reality of the algorithm is far more demanding. The top tier of borrowers, those consistently securing the absolute lowest possible interest rates, maintain a ratio in the single digits. In the strict eyes of the scoring model, lower is always better, and zero is the ideal state. Further confusion frequently occurs when consumers mistakenly conflate this specific metric with their overall debt to income ratio. It is crucial to understand that credit utilization strictly measures revolving debt against credit limits, completely ignoring how much money you actually earn from your salary. A high earning executive with a $2,000 credit limit who spends $1,500 a month will have a terrible utilization ratio. The algorithm measures your discipline strictly within the boundaries of the granted credit, entirely separate from your overall personal wealth. Regaining absolute control over this volatile metric requires a strategic shift in exactly how and when payments are timed. The reporting agencies do not monitor your balance every single day. They receive a single automated update from your credit card issuer, typically occurring on the statement closing date. By paying off the vast majority of your balance a few days before this specific closing date, you dictate exactly what number gets reported. You effectively manipulate the digital snapshot to show a near zero balance to the scoring models. Implementing this early payment strategy yields rapid and highly tangible results for your overall financial profile. Because utilization is calculated in real time based exclusively on the most recent data provided, a high ratio from the previous month is completely forgiven the moment a lower balance is officially reported. A consumer can watch their score leap upward by 30 or 40 points in a single billing cycle simply by changing the date they click the payment button. The power dynamic instantly shifts back to the informed individual. However, well intentioned financial cleanup efforts can sometimes backfire
backfire spectacularly if the underlying math is ignored. When someone decides to aggressively close old, unused credit card accounts to simplify their financial life, they inadvertently slash their total available credit pool. If their existing daily balances remain exactly the same, removing that available limit causes the utilization ratio to instantly and violently spike. A deliberate move meant to demonstrate financial responsibility instead triggers a sharp algorithmic penalty that can take months of careful management to fully reverse. A highly effective, somewhat counterintuitive tactic to suppress the ratio involves actively asking lenders for more financial rope by proactively requesting a credit limit increase on existing well-managed accounts. You instantly expand the denominator in the utilization equation. If your limit suddenly doubles from $5,000 to $10,000, a $2,000 balance immediately drops from a 40% utilization rate to a highly favorable 20%. This mathematical maneuver improves the score significantly without requiring a single change in your actual daily spending habits. Mastering this specific calculation unlocks profound real-world advantages when navigating major life transitions and large purchases. When applying for a mortgage to purchase a family home, the subtle difference between a good score and an elite score dictates the exact interest rate offered by the bank. A consistently low utilization ratio ensures the borrower is presented as the safest possible investment to the underwriter. This translates directly into substantially lower monthly payments and vastly expanded purchasing power in an increasingly competitive housing market. The long-term financial impact of ignoring this vital metric is staggering when viewed across an entire lifetime. Over the lifespan of a standard 30-year mortgage, a slightly higher interest rate caused by a bloated utilization ratio can easily cost a homeowner tens of thousands of dollars in unnecessary interest payments. That is generational wealth quietly drained from retirement accounts, college funds, and daily quality of life, all because of a misunderstood mathematical fraction. The invisible penalty compounds relentlessly over time, silently eroding financial independence.
Understanding these high stakes transforms the credit score from a source of lingering dread into a manageable, highly predictable tool. The deep anxiety of applying for a major loan dissipates when you know exactly how to optimize your digital profile weeks in advance of the application. It replaces the helpless feeling of being judged by an invisible authority with the quiet confidence of an insider who knows exactly how the machine works. This newfound clarity breeds a much deeper, more resilient sense of personal financial autonomy. In broader economic climates where institutional lending tightens and baseline interest rates rapidly climb, banks become hypersensitive to any risk indicators. During these volatile periods, creditors heavily scrutinize utilization ratios across their entire portfolio, actively reducing limits for borrowers who suddenly appear overextended. This defensive posture by massive financial institutions can easily trap unaware consumers in a vicious cycle where a lowered limit artificially inflates their ratio, further damaging their standing and triggering even more severe restrictions from other lenders. To permanently insulate against these systemic macroeconomic shocks, the most resilient households actively automate their utilization management. They set up multiple, smaller monthly payments, clearing balances weekly to ensure the reported number remains perpetually low, completely regardless of when the official snapshot is taken. This proactive, systematic approach completely removes human error and memory lapses from the equation. It absolutely guarantees that the unforgiving algorithm always sees a highly disciplined, low risk borrower, protecting their score from sudden, unexpected drops. The compounding effect of this automated discipline is a rock solid financial foundation that effortlessly withstands broader economic turbulence. As the score steadily climbs and stabilizes in the upper tiers of the FICO range, the heavy doors to premium financial products swing wide open. The individual is no longer begging for basic approval. They are actively courted by competing lenders offering the most incredibly competitive terms available on the market. This operational mastery represents a definitive hard won victory over the opaque financial systems of the past. Beyond the immediate and obvious mathematical benefits, this elevated level of financial literacy ripples outward into every single aspect of life. It fosters a permanent culture of intentionality where daily spending is no longer a passive activity, but a highly strategic decision aligned with long term goals. The echoes of those careful choices follow a family for generations, permanently replacing a legacy of debt anxiety with a clear blueprint for wealth accumulation. It is the ultimate empowering shift from merely surviving the economy to actively leveraging it. Ultimately, your credit utilization ratio is not a moral measure of your worth, but a highly sensitive mathematical instrument you can tune to your absolute advantage. By fiercely protecting your available limits and strategically timing your routine payments, you dictate the exact narrative reported to the financial world. Demystifying this single mathematical relationship is a critical, unavoidable step in taking absolute ownership of your personal financial trajectory. It is the master key to transforming borrowed money from a heavy liability into a powerful, unstoppable engine for lasting prosperity.